Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Today is election day. After months of leadership uncertainty, Canadians will soon have a leader with a clear mandate. What might this mean for investors, for future interest rate decisions as they come, and as we close out the second quarter, what can recent flows tell us about investor sentiment? We're actually closing out the first quarter. Joining me today to discuss how the second quarter will look like, a review ultimately of what has happened so far this year, and for a look at what is unfolding and how it ultimately might come into impacting your portfolio is Fidelity Director of ETFs, Andrei Bruno. Andrei, great to have you here. You're the man for the moment, actually. Welcome back.
Thank you so much. It's always great to be here.
Yeah, on election day, we're going to go into the flow story specifically and what we're seeing macro. But first, let's just ask you a bit about the election and the significance of having, I guess, a little bit of certainty?
Yeah, so, obviously the election's been a long time coming here, obviously with the resignation of Justin Trudeau several months ago. I think what's good for Canada is we're going to get a little bit of certainty, at least on the political side. So obviously a lot has happened. Obviously everyone's paying attention. There's a trade war going on, a lot of tariffs going on. And, I think with this kind of interim government, so to speak, there's been a lot of uncertainty on the Canadian side. So I think at least whomever is elected today, and whoever becomes the next PM, at least we'll have a government with a mandate and a government who can, ideally negotiate and get us through this trade war here. So I think net positive for Canada either which way. We'll get a little bit of political certainty on our side of the border.
It's interesting. Let's just go through a couple of the main things as it works for probably international investors and investors here. I mean, there's a big story certainly around the resources that this country has and the story of how we might sell those to the world in a better way, faster, is sort of one piece of it. Is there anything to say on sort of certain sectors that you're looking at?
Yeah, I think generally, if you take the two main platforms, I think generally, the outlook for Canadian resources is a little more positive than it has been over the last, 10 years, so to speak. If we think about our oil and gas sector, hasn't really expanded in the way it previously had in other years. So I think, things should be a little bit more positive there. And net, I think that's going to be more positive for Canada as well. So I think there's a little bit of positive surrounding our natural resources, whomever ultimately takes control. I think the realization with the tariffs and the trade war is that we need to get our resources to market, and building the infrastructure to assist in that matter will be paramount for Canada on a go-forward basis.
So you run the ETF side of things. You're a bond guy, though. You come from looking at interest rates, looking at yields. Let's talk a little bit about inflation from tariffs, expected inflation from tariffs, ultimately the bond market and what you've seen it do. We're going to go into sort of a story of flows, but just a couple of points on the macro story. What is your view on inflation at this point, if you can have one?
Yeah, so it's relatively tame. Right now we're hovering just above 2%, whether you're looking at Canada or the US, just a couple ticks above the 2% range. And just as a refresher for folks, so in Canada, we have a 1% to 3% band, which is what the Bank of Canada looks at. In the United States, they have a 2% target. So you might say, why does that matter? Who cares? Well, if we think about central bank policy in Canada, we have a single mandate. Central bank is keep inflation within that 1% to 3% band. We're sitting just above 2%, so comfortably within that band. Now, to contrast that with the US Fed, they've got a 2% target, and ideally they're looking to get pretty close to that, if not above that. We're still a little bit above that. But they also have a dual mandate, so inflation as well as full employment for the economy. Employment's looking pretty good.
It really has been.
Just to tie it back to inflation, though. So right now it seems pretty tame, but obviously with the tariffs, we've only had, a little under a month of that to funnel its way through. I don't even know if any of it's funneled through yet. But, Econ 101 says that's going to be inflationary. So I think the concern right now for both the Fed and the Bank of Canada is we don't want to get into a stagflationary environment. We don't want the economy to slow, which typically a tariff regime portends to a slowing of the economy. As you can imagine, it creates friction, uncertainty in the economy, which corporations do not like. Uncertainty is the one thing corporations do not, among others. So again, we don't want to end up in a scenario where we might be getting inflation from these tariffs. We cut rates, all of a sudden we exacerbate that inflation story. So I think the Fed's certainly thinking about that. I think the Bank of Canada is certainly thinking about that as well. But all that to say is the Bank of Canada is a very comfortable spot, inflation where it can be. I'd say they have probably a little bit more wiggle room to cut because we are within that band. On the Fed side, they've got pretty close to maximum employment. Employment's very good there.
There is an employment report coming out on Friday.
There is. So maybe I'm going to be wrong in a few days.
Well,
in a few
not looking
days.
for you to be wrong, but we all seem to be looking for something to shift, to reflect ultimately sort of in the hard data story.
So what you are seeing in the U.S., however, is if you look at the JOLTS numbers, so jobs opening and loss numbers. So job openings are starting to trend down. Temporary workers are also trending down. That's typically a bit of a leading indicator to the overall employment story. So maybe something's coming. And you have to think with all this uncertainty surrounding tariffs, in that environment, if you're a corporation, you're probably not thinking, now is the time to hire, now is the time to spend more money. If anything, you want to be steady as you go. So it might not lead to layoffs per se, but I don't think it's going to lead to, it probably will. Yeah. But it's probably not going to lead to more job postings at the very least.
Right. Okay. And the Bank of Canada does not have that as a mandate, but they do respond to an economic situation ultimately.
Absolutely, and again, I think even coming into this year prior to the tariffs, I think when you were looking at recession probabilities, it was certainly higher in Canada relative to the U.S. And now all this tariff news is certainly exacerbating that potentiality.
Okay, so how have you watched this inflows? Because this is sort of fascinating to see what the flows are showing. Like, what are investors doing?
Yeah, so we're certainly seeing a pickup in fixed income for sure. If you take a look at the flows in the ETF landscape in Canada anyway, it's almost been evenly split between equity and fixed income. I think equities are edged out by about $1 billion, which seems like a big number, but in the total $30 billion flows into the ETF space this year, it's relatively close. And then when you dive into the data a little bit more, you look on the equity side of the ledger, it's been mostly international.
This is a huge story this year. Yeah.
Yeah, and I think that was, trade war started coming up. Everybody started looking elsewhere for opportunities. If you look at the valuation difference between Europe and the US, it is fairly wide. There's always, kind of a premium to the US relative to Europe on a price to earnings basis, but it is fairly wide. So people are starting to think about, is there some opportunities in Europe? And, I do all this to say is, Europe is also affected by the tariff situation as well, right? They're not insulated from this.
They're just cheap.
But they're cheaper. So if you're thinking about a risk-reward perspective and a valuation perspective, I can understand why folks may be looking elsewhere there. When we take a look at the fixed income side, what we've been seeing is a lot of flows into Canadian fixed income, and then broad market exposure as well as money market. So folks, which makes sense. A lot of uncertainty, money.
People go to the money markets. It's cash-like.
Exactly.
So does that basically paint a picture of uncertainty? Is that if you were to look at all the flows, they sort of tell you, what's the headline?
Yeah, I think that's a key theme here, is uncertainty. Okay. And obviously markets do not like uncertainty. I know I probably speak for all the viewers in saying that we just like markets to go, gently and up and to the right. Yes. I don't think that's going to be the story over the next 6 months. I think we have to continue to expect more uncertainty. And here's the thing is, I don't know if anyone knows for sure. I can't say for certain, are we going to be in a recession in 6 months? Is this going to be a blip for a couple months and then we're going to continue on kind of mid to late cycle up and to the right gently? I don't really know. And I don't know if anyone knows for sure. I would venture a guess that no one knows for sure. But I think the key take-home message here is, we're not running for the exits just yet. I wouldn't recommend, parking everything in cash and just saying, let's wait it out. At the end of the day, this is why we build the portfolios that we do. We take into account what's our investment horizon, what's our risk tolerance, and we build portfolios so that they can weather these types of storms.
Even this type of storm?
I think so. Not to say you should just
do nothing.
Do nothing.
Right.
It might make sense to take a look at some more defensive names, whether you're looking at defensive sectors like healthcare, utilities, consumer staples, which have been performing as you'd expect in this type of environment, or even on the factor side, taking a look at, low vol, for example. So I think it's really good at this point is to take a look at your portfolio. Where are your risks? Whether it's a factor perspective, am I, overweight growth, am I overweight value? Where do my risks sit? Taking a look geographically, where do my risks sit as well? Taking a look at your asset allocation, of course, as well. If you want to get a little more dependence, maybe think about the fixed income side of your ledger a little bit more. And even within fixed income.
Let's go into this. So within fixed income.
So, if you look at returns this year, it's kind of been like US Treasuries, even though we have seen the Treasury curve move higher on the kind of medium, outside of 10 years, we've seen that actually move higher this year. They've still been performing decently well. If you look at high yield and loans, kind of haven't been performing quite as well. If you went back, I think last year and the year before, certainly during the rate hike cycle time, those were the best performing asset classes within fixed income. Not so much this year. In fact, I think I've been on probably a dozen times with you over the last couple of years, and whenever we talked about credit spreads, it was basically like nothing to talk about.
It was a non-event.
We have seen credit spreads widen out, whether you're looking at investment grade or high yield. If you rewind back to the start of the year, they were probably trading close to 1 standard deviation tighter than the 20-year average. So we're above that, but we're still below the 20-year average. So it's not, alarm bells aren't going off in the credit market, but we are seeing a widening out in spreads, which is obviously something we want to keep a close eye on.
So much of it, speaking of asset allocation and not running for the hills, is we've learned that much can be undone quickly. I mean, much debate about what a Trump put actually is. We maybe thought it was one thing, maybe it's something a little bit different now. But the fact is things can spin pretty quickly. Just talk about sort of, I guess, being able to take advantage of those when they're there, because sometimes they come really fast and furious, you don't know.
Yeah, it's my kind of opinion that, the administration can only tolerate the market going down so much. I mean,
which market?
The equity market, I would say. Obviously, when you think about rates as well, and you brought up Scott Bessent, Treasury Secretary there, I think he's very in tune with what's going on in the rates market. If you see some of those key rates hit that 5% target, there seems to be he seems to trot out and try to smooth
less
things
tolerance.
Exactly. So I think they're very cognizant of that. There's quite a bit of maturities and treasuries coming up. I think it's somewhere around $1 trillion. Like it's quite a bit. So they're very cognizant of where rates are and where they're going to have to refinance a lot of the treasury debt. So I think there's two things there. There's one side of the ledger where they can only tolerate so much pain on the equity side, which they've tolerated quite a bit of pain.
It's actually
probably more than I would have expected had you asked me personally. But I think that rate side of the ledger is very, very important to them as well, and they're very cognizant of where that 10-year, where that 5-year number hits.
Really, really interesting. If we come back to Canada for a sec, there's lots of interesting pieces of our economy that are getting hit. You spoke a bit about resources, maybe having some clarity there in terms of sectors and what's going on here. One big thing that we all know is coming and have for years now is the mortgage renewals. You'll correct me if I'm wrong, but it's generally thought the banks have obviously seen this coming, and there's sort of some comfort with some stress testing that was done some time ago. So it's an event. It was thought not to be catastrophic in any way. We have a different economy than we did a couple months ago, though. Put that into perspective for us for the Canadian economy.
Yeah, my kind of, when I take a look at that, the mortgage market, like to your point, the banks have done a good job of getting ahead of it. I don't think we're going to see kind of a massive credit event type situation in the mortgage market. What I think we will see though is, the bank has lowered rates, which is kind of going to provide a bit of a shock absorption to some of those refis. Now, even where we are at current rates, I still think a lot of folks are going to see their payment go up a little bit. And at the end of the day, whether it's a little bit or a lot, at the end of the day, the last thing they're going to default on is their house. So they're going to pay their mortgage. What they're going to do is reduce spending elsewhere. So I would have to think, in the absence of cutting all the way down to 2% or sub 2%, because you got to think a lot of these folks refied around 2% on their mortgage rate. Like when overnight rates were 0, 25, 50 basis points, right?
In the pandemic.
Exactly.
Broadly speaking,
during the pandemic. So even if we get down to 2%, like folks are still going to see a slightly higher payment. And again, that's going to trickle down to consumption, and we're a consumption-based economy. So again, more headwinds for the Canadian economy there.
Is this the right time for bonds, either CAD or US, with the potential for inflation? For instance, will low US T-bill demand cause rate drops to be stalled or even increased in the US? Yeah, kind of a comparison.
So it's a good question. So you have two things battling there, right? So you have, typically in a recessionary environment, you see long end rates come down, right?
Not so now. Yeah.
Right now, you're not seeing that because I think what the bond market's telling us is we've got tariffs, we've got potential inflation. Typically, that long end responds to growth and inflation. So I think right now it's responding to the potential for inflation, and we're seeing rates move higher. But we are seeing some interest in the shorter end of the curve for fixed income. which is probably, potentially a safer area to play. Again, if we get into a recession, I think that long end's going to come back down. Right. At the end, I think tariffs or not, that long end's going to get bid. People's going to flock to safety. But right now, given you have that inflation overhang, but if you are still looking for safety in fixed income, that short end is kind of a safer place to play. And in fact, if you look at the curve between 0 and 10 years, those rates have continued to come lower. Right. It's when you start getting outside the 10-year range where rates have been drifting higher. So again, you can get that safety from whether it's treasuries or investment grade corporates. You can get that exposure on the shorter end of the curve and avoid that inflation scenario where long end rates push higher.
It's really interesting. They've brought in, though, the idea, you said, CAD or US with the potential for inflation. Okay, so you've answered that. Perfect.
Yeah, the curve has been kind of responding similarly in Canada and US in that 0 to 10 year range.
How much are you interested in the European market and Far East, including Japan, India? I was going to ask you a question about China, which has been fascinating, obviously, in the sphere of the tariff story. But tell us about more on the international side, not just Europe, other places as well.
Yeah, so China has been interesting. The market there has been up this year. I think they came out of kind of their recessionary environment, their slowdown.
Yeah. They're slow out of it too, though.
Slow out of it. It's been a slow rebound. But so you're looking at the returns there and you're saying, okay, things, the equity market's doing okay. But then you also overlay that with tariffs. It's not just that the U.S. is getting, the U.S. is kind of the number one consumer of Chinese goods. So that's going to create an issue for Chinese from a net exports perspective. And then, if you look at commodities as well, typically what you see is, if China is kind of trending positively, you should typically see iron ore prices respond. There'll
be a bid there.
I believe they're the number one consumer of iron ore globally. Iron ore prices have been down this year. So it's kind of,
and then oil's doing weird stuff too in the global market because of
oil's been down this year. Gasoline prices are up, however, so not great for inflation. So that's been interesting. You take a look at base metals; it's mixed. I mentioned iron ore has been down, but nickel and copper have been up. Aluminum's been down as well. So a bit of a mixed bag there. Generally, energy prices have been down with the exception of gasoline. What has been up a lot are precious metals. If you look at gold and silver, which again is another area folks are flocking to from a safety perspective.
For sure. It's been fascinating. So the role of alts as well, because if we go back to the asset allocation or making sure that you're sort of staying in the market in whatever way that is, the role of alts, liquid alts particularly, for that maybe 40 side of the portfolio. Just take us through how that has worked out recently.
Yeah, I mean, certainly I'll speak specifically to Fidelity. We've been seeing more interest in our alts. We do have a number of alts on our ETF line. We have been seeing an uptick in flows into those during this period. And I think ultimately it's a lot of folks thinking back to 2022 where we had everything down.
Yes.
And it's looking for
the correlation story all broke down.
Exactly. So it's folks looking for stuff that isn't correlated in the same way to traditional asset classes. But also, in a sense, I think why people are utilizing them as well is you can think about, liquid alternative equity mandates. They have a different correlation profile relative to underlying equity markets, but you're still able to get, and it comes down to, we think about folks not wanting to miss, what happens right now. We don't know if it's going to go up. We don't know if it's going to go down. It's like, how can I get exposure to something that is going to protect me a bit on the downside, but is also going to allow me to participate on the upside. Right. So I think liquid alts do a good job of having a different risk-return profile relative to traditional asset classes.
Which works in a time where there is, sometimes there's some whiplash in markets, right? And people are feeling that. So, okay, so it's a really interesting time for that. Diversification, what does, if there is a breakdown of the 60-40, and I'm not suggesting that there is, but some people do, what does asset allocation look like for someone trying to plow through this market? Maybe their time horizon, let's throw one out to you, is they're say 20 years away from retirement. Let's say they're 15 years away from retirement. How do they stay in?
Yeah, it's a great question. I mean, ultimately, this is why we build portfolios the way we do. We consider the asset allocation. We consider the investment horizon. We consider the risk tolerance and what the financial goals are when we're building a portfolio. And I think this is one of those situations. And again, it is tough, right? You have clients calling you saying, all I see is red in my portfolio. Like, what are we doing about it? It's very tough to stay disciplined in a time like this. Like, ultimately, ideally, we build a portfolio that can weather times like this. Not to say, our portfolio is going to necessarily be perfectly positive in times like this, for sure. But we're building resilient portfolios so that over that investment horizon, we're trying to maximize our compounding effect over that time period. Because the other thing to consider as well here too is, in a perfect world, we could time markets perfectly, go to cash, 100% cash perfectly at the moment when markets go down, and then jump right back in at that inflection point at the bottom as well. Fortunately, no one's very good at that. Right. And what the data...
Everyone thinks they are, though, or enough people think that they are.
Yeah, fair enough. And, if someone could do that consistently over every investment cycle, I mean, that's where the tough part comes in. Some people do over one investment cycle, but to do it over each subsequent investment cycle is near impossible.
Just take us through. There's some statistic which that I don't. There are a certain number of days within a bull market that if you miss out on them, which is always the worry, if not catching it when it starts to come back. What is that statistic?
Yeah, it's and I have to dig in my brain here, but I know we've run some numbers based on if you miss the 10 best return days in a bull cycle. Let's look at a portfolio that stays invested, and let's look at a portfolio that missed the 10 biggest up days. The return profile is vastly different.
Really?
Yes. So ultimately, kind of the take-home message here is, while we get volatile markets going down, our instincts just say, let's get out of the way, let's get very defensive, go to cash. The data suggests kind of staying invested over the time period. Not to say you should look at more defense in times like this and try to insulate your portfolio further. I think you should absolutely do that. But ultimately, we also don't want to miss those rebound days. And given the type of situation we're in, where we have an administration that is very mercurial and one day comes out and says tariffs, next day comes out and says there's no tariffs, you are, a tweet away or a statement away from missing a 10% update, which we got a few weeks ago when markets were up 10%.
Is there anything for everyone to know about the currency markets right now that you think is quite material? Because there was discussion about de-dollarization. That said, a couple of not even tweets, but just sort of appearances by Scott Bessent actually seem to waylay some of the fears, and actually the US dollar came back up. So to what extent should everyone be paying attention to currency? Yeah,
it's an interesting scenario. Usually when there's recessionary fears, markets are going down, people typically flock to safety. So treasuries, US dollar gets bid. We're not seeing that exactly right now. The US dollar, I think, if you look at against G10 currencies, is the weakest performing currency relative to those year to date. What I will say about de-dollarization is, this has been, as long as I've been in the industry, we've been talking about this.
That's right. It's always been sort of that circulating.
Are we going to move away from the US dollar? And typically reserve currencies are in the spotlight for about 100 to 150 years, historically speaking. Obviously, historical results don't necessarily indication of what's going to happen in the future. But if you look at the pound sterling, even the Dutch guilder prior to that, that was typically kind of the time frame. So we're probably at, the 70-ish year mark, post-World War II regime. The other thing I always ask people when they say, the US dollar is no longer going to be the reserve currency, the question I always ask them is, what's going to replace it?
Oh yeah, what is?
I personally don't have a good answer for that just yet. Not to say it won't happen. What you are seeing is central banks are putting more gold on the balance sheets, which is probably one reason why you're seeing gold so bid. But that's been kind of more of a trend over the last year or two. We've seen more central banks buy into gold. I just don't see anything dethroning the US dollar today.
Right.
Could it happen? Of course. I just don't know what the good replacement would be.
Another great question. So this has to do quite directly with currency. It's perfect timing. How is Bitcoin, other crypto correlated to the market right now? What's your outlook for these assets?
Yeah, so it's a good question. So I'd say Bitcoin is rebounding a little bit right now. It got hit pretty hard. I'd say in terms of safe haven, I'd say gold's been acting a little bit more safe haven than say Bitcoin. I'll speak specifically Bitcoin. I know there's a ton of other cryptocurrencies out there, whether Solana or Ether or what have you. I think certainly Bitcoin on a long-term horizon, I think it has staying power. This is just kind of my personal opinion. Just the way the protocol is set up, just the way the adoption from the overall community, what it's going to end up being down the road, I'm not 100% sure. I'm not sure anyone. I'm sure if you go onto Twitter, you'll have a lot of people who tell you exactly what Bitcoin's going to be. I'm unsure, but I know it does have some staying power. I personally have a little bit in my portfolio. But I like it as a long-term asset class. What it ultimately ends up, I'm not 100% sure just yet.
Okay, really interesting. So the idea of not a time for sudden moves, but maybe making some adjustments. So let's just sort of circle back to that to finish out some of the thoughts you brought here. So the flows are telling you uncertainty, which is what most people are telling us that the market says right now. With that knowledge, what then to do in terms of adjustments, if you think there should be any?
Yeah, I think moving forward, if you've got a little concerns about the uncertainty, I think taking a look at adding a little bit of defense to your portfolio. So whether that's taking a look and seeing where your factor risks on your equity side. Maybe think about adding a little bit of low volatility to dampen things out. Maybe take a look at your geographic exposure. If you've got your eggs in a lot of baskets, I know probably over the last 2 years or 3 years or so, we've been saying US, US, US.
It's been the TINA trade, yeah.
Exactly. So thinking about maybe diversifying a little bit there as well. And then on the fixed income side, I think taking a look at your high yield exposure, whether it's looking at loans, high yield bonds, and just maybe reassessing there and thinking about maybe treasuries or investment grades a little bit more during these turbulent times. Because ultimately, when credit spreads widen, typically that goes down the stack, right? High yield feels it a little bit more, loans feel a little bit more. So if you want to be a little more defensive on that side, you might be sacrificing a little bit of yield, but ultimately, spread widens 200 basis points, that extra little bit of coupon won't necessarily help you in that scenario. So,
okay, yeah. Any final thought just for investors?
That's what I was just saying.
Yeah.
It's a good time to take a look at your portfolio, see how you're positioned, think about your diversification, think about adding a little bit of defense in the portfolio, and staying vigilant out there.
Okay, great moment to have you speak to us and kind of talk us through this, Andrei Bruno. Thank you for joining us.
Thanks so much, Pamela.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.